No ifs, no buts, and plenty of rate cuts.
Yes, it's looking like we may have at least 3 rate cuts lined up for the next year.
Yes, we are heading rapidly towards a low interest rate environment, and we're here to help you navigate the path to it smoothly. I'm Jack Izzard.
And I'm Peter Stimson.
Welcome to The Rate Stuff. If I'm absolutely honest, I'm a bit over the whole Trump thing. I've tried desperately to think of something else to lead this episode on, but we just can't do it because here we are 100 days into the Trump presidency and he has caused chaos for the mortgage market. He's spooked the financial markets, he's sent swap rates tumbling, and Peter, we're seeing that feed now into mortgage interest rates, aren't we?
We are, yeah, unfortunately he's front and centre of every conversation. There's no getting away with it. It started off with, the threat to sort of annex Greenland, Panama Canal, build hotels in Gaza.
Yeah, that was kind of entry-level bonkers, wasn't it?
It was offensive, bonkers type thing. Then we got the sort of the whiteboard with the tariffs written on it.
Oh yes, like a supply teacher with his
It was a
board.
supply, exactly.
Going to tax those penguins there. Going to attack the Chinese there.
Yeah.
Liberation Day was the real bombshell.
It was. Yeah, I mean, so if you look kind of what's happened to swaps since the 2nd of April, they've dropped by 40 basis points on the 2-year side of things and 35 basis points on the 5-year side of things.
That's a lot very quickly.
It's a lot quickly. So, that's feeding through into mortgage rates, as you can see what's happening now. So you've got, a lot of the leading 2-year rates now below 4%. 5 years now dropping below 4% at the start as well. So that's pushing through quite quickly.
And I guess the reason those swap rates have come down so fast is because the markets are looking out at the next year or so and seeing multiple cuts to the bank base rate.
They are. A lot of the pressure on interest rates seems to be dissipating. So obviously we've had the notification from the IMF that they think the UK's growth forecast is going to fall. So it was 1.6%. They're now forecasting 1.1. A lot of the pressures around inflation seem to be dissipating as well. Obviously, the dollar has dropped against the US pound by around 10%, and a lot of goods are denominated in US dollars. And obviously, Trump still has tariffs on the Chinese of around 145%. So a lot of those goods are now going to be looking to find a home, and that home could well be the UK and Europe.
So we've got this wave of cheap goods coming here. I mean, if you think about it, we're in almost the polar opposite position to where we were 6 months ago. Now, the risk is all recession, not really inflation. You've got these deflationary things coming down the track. So that's why the bank is very much focusing on cuts now, right?
Yes, so, they're looking at potentially ways to stimulate the economy. And some of the inflationary pressures are dissipating. So short term, we've still got some inflationary pressures pushing through. We've obviously got the national insurance hike coming through, and obviously the minimum wage pressure coming through. But looking out sort of longer term beyond that, there's some sort of potentially some deflationary pressures coming through from that side of things.
Yeah, I mean, it has been a complete turnaround, really, hasn't it? Most of it bad in that it looks like we're heading for a global trade war, a global recession, but with our very narrow mortgage focus on, rates are coming down, aren't they?
I mean, the positive side is cheaper mortgage rates. I mean, you've now got lots of 2-year rates starting below 4%, 5-year rates now starting to turn out below 4% as well. So, if you're looking to borrow money, guess what? It's getting cheaper.
Yeah, I'm not sure how long my heart can handle this, though. This is the other danger, is just the sheer stress, the sheer volatility of the Trump effect. You just never know what's coming next. But look on the bright side, we're 100 days down, just 1,361 to go. Okay, so let's map out how those cuts to the base rate might play out in the mortgage market. The obvious one, Peter, of course, is cuts to interest rates, but base rate cuts are having other effects on lenders as well, aren't they?
They are. So, interestingly, the FCA, sort of under the direction of Rachel Reeves, has asked the lenders to look at affordability. So, can lenders be more flexible around affordability? Quite interestingly, obviously, every time the bank base rate gets cut, lenders' affordability improves because obviously lenders are using a stress rate which is linked to their SVR, and lenders' SVRs are invariably linked to Bank of England base rate. So at the moment, most lenders' SVRs, when you add a stress rate, are using an affordability calculation or stress at around 7.5%. Assuming we get a cut to Bank of England base rate on the 8th of May, that's going to mean another 0.25% cut to lenders' stress rates. And assuming we get the sort of 3 cuts this year, it's probably going to mean most lenders are stressing, we think, at around about 6.75%, something like that. Now, if you go back to the good old days, for using inverted commas, back to when interest rates were incredibly low, which was sort of, start of 2023, that was kind of the stress rate lenders were using back then.
Yeah.
So you're going back, even though interest rates are still obviously much higher than, or will be much higher than when they were then, you're using a stress rate, or will be using a stress rate, which is kind of almost back to where it was then. So, that's a pretty interesting position to be back in.
So in practical terms, that means for the same income, lenders will lend more.
It does. And it means lenders will effectively be lending almost the same amounts as they were back in 2023.
Right. Okay. So from a borrower's point of view, happy days.
Happy days. And like for like, if you take, for example, a lender's position now and a lender's position, for example, in, say, a year's time, assuming we get 3 bank base rate cuts, like for like, you could potentially be borrowing or lending another 15%.
Okay, a couple of aspects of this. First of all, what's driving it? Is it the FCA? Is it Rachel Reeves? What's the kind of motivating force?
It's really looking at ways you can get the market moving. Are lenders, or have lenders been too strict in their affordability guidelines? So it's really looking at ways to sort of open the market up and seeing if lenders can be more flexible, particularly around first-time buyers. So, for a first-time buyer who, is trying to get their first, rungs on the ladder, first feet on the ladder, can lenders be more flexible to first-time buyers? So I think particularly with regards to affordability, lenders have to be cautious, have to be careful. So, lenders are not going to lend someone more than they can afford to do. Lenders will be more flexible, particularly on longer term fixes, because obviously there's a longer time horizon. Someone has more stability, for example, on a 5-year fix than they do on a 2-year. And if interest rates do continue to fall through time, so for example, we're talking about 3 bank base rate cuts potentially built into the swap curve at the moment, but God forbid, if we do go into a sort of a recession or a severe recession and we get more than 3 or 4 or 5 base rate cuts, I think there's going to be a floor or a cap on where lenders set affordability. So when we went into the very low interest rate environment, most lenders capped affordability at around about the affordability assessment around about 6.5%. I think we'll probably end up around about there again, because even if interest rates end up at 2.5%, 3% or something like that, you won't be assessing much below 6.5%, I would have thought.
Let's just take off our mortgage lender and mortgage broker hats for a second and look at the bigger picture. Isn't there a danger that if lenders are all willing to lend more,
yes,
people are going to start paying more for their houses? It's going to create another house price bubble, isn't it?
There is that risk. House prices ultimately are a function of affordability. So, if you go back to the sort of period 2000 sort of 10 to sort of 12 through to sort of 2018, you did kind of get this sort of house price growth driven by a very low interest rate environment. So there is that potential risk.
Yeah, so you get this sort of doom loop, don't you, of house prices rising, affordability weakening, so lenders have to start lending more. You're constantly chasing, aren't you?
A little bit. I think that's probably a big question and probably one for another episode. But yes, there is
We'll say that over the pub later on.
Yeah, it's almost a goal. It's almost a discussion about what is a Goldilocks rate. That's another episode, I think.
Peter, keep quiet. That is one of our topics for a future episode, because that is going to come to the fore, because we're going to see many interest rate cuts this year. And the question, of course, is how many rate cuts is too many? How low do we really want it to go? But let's park that and join us in another episode for that one. It's time to put Peter on the spot, and this episode we have got a Mortgage 101 question. Given that we're talking about bank base rate going down several times in the coming months, it looks like the only way is down for mortgage rates. And in a context like that, Peter, surely the only way to go is a tracker rather than a fix, right?
Probably not, is my view. If you look at the best tracker out there, you're probably looking about bank base plus 29 basis points, which gets you to about 479. Best 2-year fix at the moment is about 389. So there's a pretty big gap. Yeah, you're looking at sort of 90 odd basis points margin there. So you've got to be pretty confident that bank base is going to fall pretty fast and pretty hard to get your money's worth. So unless you know something that perhaps I don't, or perhaps the market doesn't, you're probably better off on a 2-year fix, I'm guessing, from that regard.
So as it is, that's a very hefty premium to pay for a potentially quite small upside.
It is. I mean, there's reasons you might want to do a 2-year tracker. If you're potentially moving home in a short space of time, or you want the flexibility, or you want to pay lump sums off and you don't want to pay any ERCs, because most trackers don't have ERCs at the moment. That might be reasons for doing it. But unless you have a very strong view that you think bank base is going to fall very hard and very fast in a short space of time, which who knows, with Mr. Trump in charge, lots of things could happen. But you're taking a big gamble, and a fixed rate probably or potentially offers better value, I think, at the moment.
Well, Peter, talking about things that you think are going to happen, we are about as certain as we can be that when the Bank of England's Monetary Policy Committee next meets on the 8th of May, it will vote by a big margin to cut the base rate. And of course, we will be here to help you unpack what that means. We'll have a full analysis of where the market goes from here. And Peter, this is, we think, going to be the first cut of many.
We think so. I mean, as things go, we think this is pretty much nailed on.
Okay, so join us next time on The Rate Stuff for your essential guide to all things mortgage. I've been Jack Izzard.
And I've been Peter Stimson.
If you've enjoyed the show, please give us a like and give us a follow on the socials.